Hi, my name is Nurul Azlin binti Muhammad Syarul.
Assalamualaikum and hi, my name is Farhani Halida binti Muhammad Fadil.
Assalamualaikum and hi, my name is Najibah binti Gulam Hassan.
Hi, Assalamualaikum. My name is Akila Nur Balkis binti Murad.
Hi, Assalamualaikum. My name is Nurul Mustaqimah binti Ismail.
I will start the presentation with the definition of insurance. Insurance is described as a contract or an agreement represented by a policy in which a group of people facing the same risk can share the loss by paying a determined premium to the insurer in exchange for the insurer agreeing to repay the loss. The type of insurance are such as life insurance, health insurance, car insurance, travel insurance, and etc.
Okay, now I'm going to explain the primary function of insurance. Insurance acts as a risk transfer mechanism. And as we all know, insurance provides protection against future risk, accidents, and uncertainty. Before that, we have to know what is insurer and what is insured. Insurer is the one who calculating the risk, providing insurance policies, and paying out the claims, while insured is the person who covered under the insurance policy. So the primary functions of insurance is where the insured, in exchange for protections, pays a sum of premium to the insurer and transfer the responsibility of loss or damage to the insurer. I'll pass to the next presenter, which is me, and I'll be explain the secondary functions. Okay, now I'm going to explain 2 points from secondary functions, which are encourage saving and offer social benefits. First, encourage saving. Why? Because insurance acts as a committed and systematic saving due to payment of regular premium, and it develops a habit of saving money by paying the premium. So the insured will get the lump sum amount at the maturity of the policy contract. Next is the offer social benefits. We as a human, we are exposed to a number of personal risks, and paying insurance is one of the effective measures to minimize such social problems by financial compensation against the losses due to such event. I'll pass to the next presenter, which is Najibah. She will explain the rest of the point for secondary functions.
Thank you to Farhanina for explaining the secondary function of insurance. So now let me continue the presentation by explaining another 4 secondary functions of insurance. Firstly is releasing funds otherwise tied up in reserve. That means by having an insurance, the business organization or individuals are able to prevent from freezing capital because they purchase an insurance and pay the premium to the insurer, so the insurer can provide financial protection against losses. So next is stimulate business enterprise. Insurance is risk transfer mechanism, so it facilitated the growth of large-scale industrial and commercial sectors. Also, these sectors might not be continued if the risk unable to transfer through insurance. So thirdly, insurance can reduce fear and worry among the business organization or individual as well. This is because insurer will protect them if any losses happen. With insurance also, the insured have more confidence and able to continue their planning of economic and improve personal efficiency. And last but not least, can reduce losses. But how insurer will help in reducing the losses in both which are frequency and severity through their action, recommendations, inspection, survey, and salvage activities. This function actually gives benefits for both parties between insurer and insured. As example, the insurance company or insurer can give incentive to insured by lowering the premium, and the insurance company can cut down their costs which used to pay the claim back. I think that's all from me. I'm passing this presentation to Akila. Thank you.
Hi, so today I will explain about the indirect function of insurance. Firstly, investment of funds. So how it works? Insurer accumulate the large funds which they hold as a custodians out of which claims are met. These funds are invested to earn interest or income in both the public and private sector. So, I will explain more how it works. Investment-linked insurance policies are policies that have life insurance coverage and investment components. Your premium are used to pay for units in one or more sub-funds of your choice. Some of the unit purchased are then sold to pay for insurance and other charges, while the rest remain invested. Next is invisible export. What is that and how it happens? So, invisible export is type of service sold to other countries. Trade in good is known as visible export, while trade in service is known as invisible export. Insurance can contribute considerably to a country's balance of payment as an invisible export. So, for example, I got one example. When individual or companies from foreign country insure in Malaysia, then Malaysia become exporter of insurance service. It can be the same when a local insurer accept reinsurance business from other countries' insurance company. Thus, this to generate income to the economy. Lastly, source of employment. How insurance function as source of employment? Insurance industry in Malaysia has created various categories of employment opportunity in economy. For example, underwriter, claim officer, and loss adjuster. There are a lot of people who work as insurance agents. They sell and negotiate various types of insurance to match the needs of their clients. Apart from protecting individuals and businesses from many kinds of potential risks, the insurance sector contributes significantly to the general economic growth of the nation by providing stability to the functioning of businesses and generating long-term financial resources for the industrial project. Among other things, insurance sector also encourage the virtue of saving among individuals and generate employments for millions.
I will continue this presentation about the benefit of insurance. The first benefit of insurance is peace of mind. Knowing that insurance can compensate for financial loss from certain risks give a little peace of mind to the insured. It is important for every individual who insure their car, house, and other possession to know what insurance coverage is, so that we are not too worried if there is a risk that causes financial loss. Besides, insurance is also very important in business because an entrepreneur can transfer at least some risk in the business to the insurer. In that, insurance is stimulus for business activity by withdrawing funds for investment. Meanwhile, business companies need to keep easily accessible receipts in order to cover any losses they may face in the future. No matter medium or large size company need to create reserve for any emergency such as fire, thief, or serious injury. The fund issue can be accessed quickly, so the interest earned by a company is lower than the normal rate. This is so when a company buys insurance, the premium paid is less than the fund that they need to be kept by the company itself. And of course, we consider the premium a loss for a company, but the company is free to continue and grow business activity with calm mind. The next benefit of insurance is social benefit. In general, if a company buys insurance, the owner of the company must have funds available to recover to any loss that happen, and the fund also become one of the stimulus for their business activity. Meanwhile, it means that all jobs will not disappear just like that. At the same time, goods and services can still be sold. So, the social benefit that we can see is that people still have jobs and lead to a maintained income so that they can contribute to the national economy. Indeed, the main loss can cause a business to close and have an impact on the community. However, the possibility of the closure of a business is not as significant as the closure of large factory. Meanwhile, if the losses cover the whole country, then the impact is very significant. Buying the insurance does not guarantee that a person will have a job, but it plays an important role in ensuring that no one suffers from economic hardship. The next benefit will continue by Mustakimah.
What is loss control? Loss control is a method focused on reducing the chance of a loss and minimizing the severity of those that do occur. This requires an assessment or a list of recommendations made by insurers to policyholders. Before providing coverage, the insurer may conduct a risk assessment first. To reduce risk, insurance companies may sometimes require policyholders to take specific actions. For example, they may require a commercial building to install fire sprinklers to minimize the risk of fire damage. Or they may require the construction of a security system to reduce the risk of theft. Policyholder can benefit from a loss control strategy through lower premiums, while insurers may benefit from lower claim payouts. Okay, let's move on to other point. I want to explain about investment of fund. An investment fund is a pool of capital from multiple investors that is used to buy securities collectively, while each investor maintains ownership and control of his shares. Insureds are not required to set a large retention funds to pay for insurance covered losses. Insurance premiums are invested until they are needed to pay claims. Okay, for example, let's assume someone is insuring his or her home. That person may not have enough spare money to buy stock, buy real estate, or lend money. However, when that person's premiums are combined with the premiums of thousands of other people, a reasonable amount of investment is provided. Okay, I want to move on to last point, which is invisible earnings. In a contemporary economy, import goods from consumer demand and by the same method export goods that others wish to purchase. There is a visible trade when these goods are tangible. Okay, for visible exports, it occurs when goods are shipped to a foreign country and paid for by that country. For example, with many different foreign individuals visiting the country in Malaysia. When tourism is at high economic level, more foreign money flows into the national economy as more customers come into the market to purchase souvenirs and service. Although the items are not visible in insurance, but the concept remains the same. Whether the goods are visible or invisible, exports bring money into the country while imports send money out.